Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
Hello everyone, this is John Larson with another episode of the Real Estate Cowboys. This week we are discussing something that I am very, very passionate about, why I stopped buying C-class investment properties. And I have so many reasons why, but the main reason is, to be frank, they just did not work. They just came with way too many problems, way too many issues, and just did not give me the passive experience that I was looking for. I'm already busy enough with my active turnkey business, with my own active retail flips that I do in the markets that I invest in. The last thing I want is problems with my rental properties because I already have enough problems and issues and things that I need to solve on a daily basis with my active investment model. When I first got my start, I'm sure if you've been listening to the Real Estate Cowboys or follow American Real Estate Investments, you know I got my start in Detroit, Michigan, actually buying, renovating, managing C-class investment properties. And I just quickly found that they just were not giving me the passive experience that I was looking for. And so many of my investors that come to American Real Estate Investments, they're really looking for good cash flow, although in today's market, like we've discussed, cash flow is becoming pretty compressed due to the rising interest rates and the rising prices. That's just the nature of the market today. But you know, I'm looking for good cash flow, but and my investors are looking for good cash flow, but they're also looking for a passive experience because I have a lot of investors that invest in Dallas or in Kansas City or in Houston or Waco is an area that I'm now really, really hot on. They want to invest in these markets, but they live in California, they live in Denver, they live in Phoenix, they live in Michigan, wherever it may be. And so it's very important to them that they're receiving a passive experience as well. And I think with real estate, you know, everybody's looking for a passive experience and trying to reap the benefits of the 6 ways that real estate pays you, which we discussed a couple episodes ago. And I think the only way you can really do that is you have to avoid these C-class properties, or at least, you know, don't buy a heavy portfolio of C-class because, like I said, more often than not, the property is going to have some issues, whether it's an eviction, a high cost turnover. Like I'm having an investor now that purchased property from us in Indianapolis. It was a C minus home. He had a bad turn, you know, upwards of $5,000. I think after the security deposit, it's a $4,500 turn because the tenants just did not take care of the property. And I tried to explain that to my investors that, look, this is some risk that you're going to be running into. You know, when you deal with C minus, D class homes, they attract C minus, D class tenants that have C minus, D class jobs, that have C minus, D class credit scores. And more often than not, these properties are managed by C minus, and D class property management companies, you know, who are not holding these tenants accountable, who are not training these tenants to take good care of the properties and pay rent on time, so on and so forth. You know, and that's where a lot of the trouble starts to occur. And not only that, now this person's going through a $4,500 turn. The property is now sitting vacant. A $4,500 turn doesn't get done in a week or two. It could take much longer than that. And then you got to get the property back on the market. You know, hopefully it's not winter. If something like this happens in a market like Indianapolis, Detroit, Cleveland, you know, any cold weather state, because then you run the risk of an extended vacancy as well. And so we've talked a lot about, you know, not chasing a paper yield. Do not buy the lie, as I like to say. You know, anybody can doctor up an Excel document to make it look like a property is going to be a great rate of return, you know, but in actuality, when life really happens and you do take ownership of this property, you start to realize that the property, you know, and the tenant that it attracts, it's a lot more troublesome. And then also that property sits vacant for an extended period of time. Let's hope it doesn't get broken into in that C minus, D class neighborhood. And so really, when I am telling my investors to buy more of that high B to A class inventory, I'm not saying it because, it looks prettier. I'm saying it because those are the properties that work. And I'd rather take a lower, stable amount of cash flow than a high peak, low valley scenario that C, C minus, and D class properties present. That's all I'm saying. And then also we want to encompass all the 6 ways that properties pay you. These rental properties pay you. We want the appreciation. Well, guess what? C-class properties don't really appreciate, and we're about to get into that. Because they're traded on cap rate, and there's no retail home buyers that want to buy in those neighborhoods. There's no retail home buyers that are willing to get in a bidding war with somebody and overbid over the asking price to win that property. That's not the way it works. These are all rental neighborhoods, 90%, 100% rental neighborhoods. That is where I've found too many times in my career that I've ran into trouble. Every time I went and tried to produce something that the investor wants and not what I know that works, I've gotten in trouble. And we've had investors, I'm not going to sit here and tell you that all the investments I've ever done have been great. I just gave you an example of an investor who invested with us in a low C neighborhood in Indy and isn't having the best experience right now. Not to say that we can't right this ship and get this thing back on track, but the problems are more common, right? I don't have high cost turns, on my A-class properties, and it can happen, don't get me wrong, but it's very rare that it happens. It's all about mitigating the risk involved with being a landlord and owning real estate. And it's very, very difficult to mitigate risk on a C-class property. It just is. So in my career, my partners and I, we've purchased, renovated, and sold over 7,000 single-family homes in 12 different markets across America. So we have a lot of experience. We know what works. We know what doesn't work. And in the Detroit market, the C-class properties, they weren't performing. In St. Louis, in Kansas City, in Indianapolis, the C-class, low C to D properties were just not working. It was like a 50-50, almost crapshoot, whether the property was going to provide a successful passive experience for the client or it wasn't. And even if it performed very well for 1, 2, 3 years, eventually there's going to be some problem that can become detrimental to the investment. And it's the tail that they grow, like I've discussed, like I've talked about. And that tail starts with an eviction, then a high cost turn, then an extended vacancy, then a break-in, then more expense to re-renovate it again, theft, so on and so forth. And the tail keeps growing to the point where it's hard to cut off. And then you as the investor, you want to sell the property because you're not having a good experience. And C-class properties are notorious for providing bad experiences for my clients to where they just decide, you know what, I'm not even going to do this anymore. I just want to sell it. And then it's like, good luck trying to sell it for the price that you bought it for, because your exit strategy is really just another investor. And what investor is going to buy a property that's having issues or that needs to be renovated and pay the same price that you paid for it? They're just not. So I want my investors to avoid those bumps and bruises. Now, there's some investors out there that don't mind the risk. Maybe they're just more so investing in real estate for the tax shelter and the tax benefits, and that's okay. We had an example of an investor who said, I own a lot of properties. He was looking to do a 1031 exchange like we discussed on last week's show. He has $500,000 that he's ready to unload into some properties and 1031 into some properties. But when he got on the phone with a member of my team, through our qualification process and our discovery process where, we try and get to know all of our investors, we found out he's only really investing in Detroit and Albuquerque, New Mexico. And I don't know what type of economic benefits there are or what type of economic growth there is in Albuquerque, New Mexico. That's not a market that's on my radar. I know Detroit really well. I know that there's not many people moving into the city of Detroit. I know there's more people moving out than moving in. And Albuquerque, not sure, like I said, from an economic standpoint, how that's, a good market in order to mitigate risk and keep properties occupied consistently, where a market like that can provide low vacancy. Because once again, these properties do not work unless you have somebody willing to rent it from you. But he said that those are the only areas that he's investing in right now. And I can see why, because those are the areas that are able to give you a high rate of return on paper. Those are the areas of the U.S. Those are some markets like Alabama. There's cities in Alabama, that are able to provide that high rate of return on paper, but it doesn't always work out that way. And actually, more often than not, it doesn't work out that way. Through his discussion with a member of my team, he told her that, well, I have a very, very large portfolio to where I can accept the risk that's involved with C-class properties. He already understands that there's a good portion that aren't going to work, but he owns such a large portfolio that more work than don't work. And that's a good strategy if you have that type of money, to where you can buy 100 doors or more and just have that portfolio going. I would say that, you can probably have more, let's say out of 100 homes, maybe 60 or 70 are performing at any given time. So the other 30 to 40% that aren't performing, the ones that are performing outweigh the ones that aren't. But not everybody has that type of capital. And in appreciation and things like that, we're not big in his mindset, which makes me feel like he's really looking at building real estate portfolios and things like that as a tax shelter and for the tax benefits. For the investor that wants the passive experience and for the 6 ways that real estate pays you, appreciation being the main one, and appreciation being the one that makes you wealthy. Okay, cash flow doesn't make you wealthy. It doesn't. Until you get to a certain amount of properties and you're able to, pay loans off and get the debt off of them and get these things cash flowing at their highest and best, they're not going to make you wealthy off the rental income. They're going to make you wealthy off the tax shelter that they provide, the appreciation, so on and so forth. That's what's going to make you wealthy. And targeting the right markets that are on a growth curve. Okay, getting in early on markets that are growing fast, targeting the right market that's on that upward trend and capitalizing on that. That is what's going to make you wealthy. Going back to C-class assets, back in coming out of the recession, I was purchasing properties for $5,000, $10,000, as low as $5,000 to $10,000, up to about $40,000, and putting $20,000 to $30,000 in the renovations. And we were selling these properties. We were holding some, and we were selling some to investors at a slight markup. Our fee for producing this turnkey property. And the homes would sell for around $60,000 to $80,000 to the investor. And, at that time, I wasn't producing anything that would sell for over $100K. And, in the Detroit market, I would probably say that the median home value at this point is probably about $200,000. But coming out of the recession, it was probably lower than that, maybe more so around maybe 160, 170. So, when you're producing that asset that you're selling at 60 to 80,000, that's a 50% decrease in what the actual median value is. And we've discussed on the show quite often that, I really recommend not to buy too far below the median value in any market. And usually with C-class, you're going to be running into that situation where you're buying well below whatever the median value is, which increases your risk. If you were to look at this on a graph, you would see a curve where, you'd see the curve as the value goes down, okay, and the rental rate goes down, the value of the property goes down. You will see on the other end another graph where the risk is going up on an upward trend. It's almost common sense to somebody that's invested in real estate consistently and has a good track record and a long track record investing in real estate. Anybody will tell you the lower grade the property, the lower it rents for, the more risk that's going to be associated with it. And the common risks, which are the evictions, the high cost turns, the maintenance to the property. C-class buildings tend to be older homes as well, which means that they just run into more maintenance issues. From what I've seen with C-class properties, the margins there for the renovation, they aren't as large for an A-class home or anything like that. And they don't need the type of renovation that an A-class home does. So you see a lot of lipstick rehabs, what I would call fresh paint, fresh vinyl flooring or fresh carpet, jazzing up the landscaping a little bit, jazzing up the exterior a little bit, but nothing too major, because it doesn't have to look that great to rent out for $600, $700, $800 a month. It just doesn't. It doesn't have to be a palace. And so those ones, just like I said, they tend to just break down a little bit easier. The materials that are used for the renovations are a lot cheaper. And that stuff just doesn't withstand as many turns, no matter what anybody's going to tell you. And what I found, and this is me owning C-class properties myself, what I found, the maintenance was a lot higher, and it was more common, it was more frequent with the type of tenants that C-class properties attract. It just seems like the people are less responsible. They don't care for things as much. The rents that I was doing at that time would probably range from $600 to $900 per month, so they were hitting that at least 1%. Rent to price point ratio, which was more common back in 2011, 2012. You could really hit those numbers. And you can kind of still hit those numbers today in many C-class markets, But that's not a great rule of thumb to identify what a good investment property is. If you ask anybody, Grant Cardone, anybody in that invests in property, a good cap rate or a good rule of thumb to buy an investment property should not be strictly on a number and a rent to price point ratio. It needs to be based, number one, on location. Okay. Location is number one. Then from there, it needs to go to what the median value is in that market. And so anytime I'm analyzing markets, number one, I'm looking at location, and then I start looking from a macro level. What's the median value? What's the median rent in this market? Where are the good, true middle-class neighborhoods? Where are the neighborhoods that I should avoid? I'm looking at economic drivers. What businesses are moving in? What jobs are being created? Are more people moving into the market year over year than moving out? What has the appreciation been? What are the days on market for the properties? Is that trending? Is that going down, days on market? Is it going up? That stuff I look for, and then when it gets to the actual micro level, then you really start diving into the neighborhoods and you start looking at what areas have maybe better schools than others. What areas are going to be able to attract the best tenants, things of that nature. And if you start analyzing markets based on that, and obviously you want to put your money in an affordable market. We don't want to put our money in California, in San Francisco for a rental property, or San Diego or LA or Sacramento, or San Jose. Those aren't good areas for rental properties, or Phoenix, Scottsdale, or Denver. Even in Texas, Austin, for example, these are all areas where you just have higher priced inventory. So, we want to make sure that we're not paying into the property every month, right? We want to provide some cash flow each month. But I'm just saying, don't get tricked into this high amount of cash flow on a spreadsheet thinking that the investment's going to be great and it's some get rich quick scheme. That's not going to work. If you're chasing a property based on that, you're already going to be running yourself into problems. That's the wrong way to look at it. And if a passive experience is important to you, then don't buy C-class assets. Passive experience is very important to me. I don't have a lot of extra time available. I'm flying to Belize this week to meet with investors down there with Keith Weinhold from Get Rich Education. We have a large group of investors coming down to see what's going on in Belize and Placencia. I'm going to be out of the country. I have a young daughter. She just turned 1. I run a couple different investment companies. I don't have time to deal with the problems that come with C-class investments. So passive income, a passive experience, truly passive income, and a passive experience is very, very important to me. So when we get back, we're going to take a quick commercial break here. When we get back, we're going to talk more about why I stopped buying C-class investments. I'm trying to help you out, Real Estate Cowboys. I'm trying to help everybody out here so you don't make the same mistakes that I did. So we'll get more onto that topic. We'll talk more about that when we come back.
Did you know there are 6 different ways real estate pays investors? Are you interested in getting started with real estate investing but just don't know how? Investing in real estate can be challenging, especially if you don't have the time, experience, or resources to do so. At American Real Estate Investments, they do all the hard work for you. They're a DFW-based company that buys homes in great neighborhoods, professionally renovates them, and places business professional tenants in your property. With their program, you can start earning headache-free passive income and equity growth from appreciating values in the fast-growing DFW market. There is no better place in America to invest in real estate today. To learn more about how their investors are earning up to 100% returns or greater with their program, give them a call at 888-323-AREI or visit their website at areiusa.com. That's 888-323-AREI or areiusa.com.
And welcome back to the Real Estate Cowboys. This is John Larson. We are talking about why I stopped buying C-class investments. And I talk a lot about, buying the lie, don't buy the lie, and don't buy a property based on a paper return or paper yield. It's very easy, I've said time and time again, to make a spreadsheet look like the investment's a home run, but in actuality, the risk is just far, far greater. And so I tell a lot of my investors all the time, if my A-class property is only generating $100 a month in cash flow, take it, because it probably really will attract or garner $100 a month in cash flow. Now, if you're comparing my A-class property to, let's say, a C-class property in wherever, Kansas City, St. Louis, Detroit, Indianapolis, and that property is going to give you $300 a month cash flow. Okay, so you're thinking to yourself, well, that's an extra $200 a month, and that's an extra $2,400 a year. And I'm sure your return, because you're buying a lower priced property, so less money out of pocket. And what is return based on? It's based on your purchase price, your money out of pocket, and then your return of money coming back in on that investment. And so I'm sure that obviously with C-class investments, they're lower priced. So that rate of return is going to look higher. But that extra $200 a month that you're getting in cash flow on paper, what is that going to matter if the property just comes with so much more risk? $2,400 a month is actually not that much money if it's just rolling back into another property due to extended vacancy where you're paying the note and you're paying the expenses, the taxes, so on and so forth, the lawn maintenance, while the property is not occupied, right? So really, what is that extra $200 a month and $2,400 a year if the likelihood that you're going to just be rolling that money back into the property due to an extended vacancy or due to a lot of maintenance or due to a high cost turnover, like I discussed with my client in Indianapolis, who's having, a little bit of a rough patch right now with one of his homes because the turn bill came back at $5,500 and he had $1,000 security deposit on hand. So he's $4,500. So he's going through a $4,500 turn and the property's sitting vacant right now. So it's a double whammy. It's a double whammy to the pocketbook. And so that's just what you have to take into consideration. That $2,400 a year between a C-class and an A-class property is not that much money if the C-class home is just going to come with more risk. And the likelihood that you're going to have to roll that $2,400 back into the property anyway, $2,400 or more, is a lot higher with that property. So we have to be very, very, very careful when analyzing these homes and just understanding, that this one is going to come with more risk than the other. And in many cases, a lot more risk. So another reason I stopped buying the properties is they were just difficult to manage. You got to always think about what type of tenant is this property going to attract. And with C-class investments, you're going to be attracting tenants that make below median income for your market. So that's another thing that I pay attention to in the market is what's the median income for the area. $50,000, $60,000, $70,000. In Dallas, it's gotten close up to $70,000. So I'm targeting people that make $70,000 or families that make $70,000, the median household income, for my investment properties. I want to target that true middle class because I know that the likelihood that my tenants at that median income are going to pay rent on time and consistently. I know that likelihood is far greater. It's the same goes for when you deviate too far below the median value in the market. Well, when you are going after tenants that make far less income than what the median income is for that area, that's also going to run into some trouble just because they don't have the consistent income, the consistent jobs. Job turnover is far greater with those, these are tenants that aren't on a salary position. They're probably on an hourly position. It's just not secure income. Well, that's how evictions arise. These tenants, in my experience, it always seems like there's a very good chance that they're paying late and your property manager is always chasing them down for rent, which will eventually result in evictions because you'll have tenants that say, well, I'll pay half now and then half later. But then you never get that half later. And now here we go. We're filing for an eviction. We're filing a judgment. The main thing with evictions that you want to look out for, obviously an eviction means that now you have somebody living in your house that's not paying rent. And some states are more or less, I should say, landlord friendly than others. California is not a very landlord friendly state. And there's other states in the union that are not very landlord friendly. And Michigan's actually one of those as well. Whereas Texas is a very landlord friendly state. You don't pay rent, you can get the tenants out very, very easily. By taking them to court if needed, simply show the judge, here's the proof, defaulted on rent, that tenant can be out within 30 days. I've seen other markets, cold weather states like Michigan, it's in the middle of winter, you can't evict them because it's freezing temperatures. In my opinion, I want to avoid those type of markets. I want to avoid that class of property. I want to avoid that class of tenant. Because I don't want to have to go through an eviction because nothing makes me more upset than with this single family rental model than when I have, a delinquent tenant that I have to evict still living in my home, and it's taking me months to get them out of there because because now I'm paying the bills for that tenant to stay there. That's not paying me. That's not a very good feeling. And that's what we want to avoid. That's a major reason why I don't like to invest in these C-class properties as well. Like I said, very difficult to manage. Very, very difficult. And I've also found that the tenants who make lower incomes are usually the people who damage your home while they're living in it. If a person can't be responsible enough, here's a good rule of thumb. If a person can't be responsible enough to handle their finances, what makes you think that they're going to be able to take care of your home like it's theirs? They're not. I ran into a lot of trouble with this with Section 8 because it's government subsidized housing. The government is paying a large portion of the rent. Well, a lot of investors are like, wow, guaranteed income. But it also makes the tenants care less, even less it seemed like, about the investment because they weren't using their hard-earned money to pay for rent. And they also knew that in order for the owner to keep that Section 8 voucher, the owner had to do yearly maintenance, routine maintenance to these properties so they could break things and it would still fall back on the owner. The owner would have to go in, Section 8 would go in, inspect the property every year, make sure that the property is up to standards for Section 8. And if the tenant was rough on the home, you really have no recourse. It's going back to the owner. The owner, hey, you want to still keep this property under Section 8, you have to do all these repairs. And with C and D class homes, really, a lot of times, all you can rent out to is Section 8 tenants. So to lose a Section 8 voucher could be very detrimental to you because there's just not a lot of market tenants out there. They're all looking for the Section 8 property. Their majority are on Section 8. So you really have to be careful about keeping that voucher intact. You don't want to lose that. And then, as I said, more often than not, my C-class properties had higher turnover costs and higher maintenance requests. It just seemed like I would have almost every month a maintenance request on my C-class homes, whereas my A-class, high B-class properties, I was rarely having maintenance. And it was just, it was very difficult for me to find a professional management company with the proper infrastructure to manage C-class homes. Most professional management companies have a minimum rent requirement that C-class homes not meet. A lot of management companies I know won't manage anything under $1,000 and won't manage anything under $1,200 because they don't want to start delving into those areas and those properties where it's just too troublesome. And it doesn't really even make sense to manage them for the 8 to 10% management fee that they're charging. It's not enough money for them to make it worth it. Most of the time what I've seen is if you're purchasing a C-class investment, you're going to have to lean on a mom and pop type of operation to manage the home. You're not going to get like a really big professional management company with the proper infrastructure in place to professionally manage hundreds and thousands of homes. You're dealing with more of that just mom and pop type of operation where more problems are going to start to arise, and these people don't have the staff or the infrastructure in place. These companies don't have that to really professionally manage these properties. So that's another thing that you really, really need to consider. And I think we talked about this, and I am going to have some more episodes coming up talking about property management, things to look for, things to look out for, questions to ask property management companies when you're interviewing them. You got to thoroughly vet these companies out to make sure that these are the right people to look after your investment. This is your hard-earned money that you're putting into homes. And if you're buying properties outside of your own backyard and relying on a management company to look after them, that really is the most important thing. It's not only buying the right property in the right neighborhood that's going to attract the right tenant. You want to set your property management company up for success, and you can do that by buying better properties, higher end properties, higher class properties. But then also, if you're going to buy, like I said, these C-class homes or any home, the management company, if they don't have the proper infrastructure in place and things of that nature, and I've just seen that many companies that manage C and D class properties don't have that, it makes it very hard to manage them. Very, very hard. And that's where the big problems can start to arise. So number 3 is, like I discussed, the properties don't appreciate. My most successful investments have been purchased in markets with high population growth and high job growth. They've also been purchased in neighborhoods where owner occupants want to live as well, not just renters. I really like to target more owner occupant type neighborhoods than rental neighborhoods because I know those neighborhoods are more desirable. They'll stay desirable years to come. It's usually because there's good schools or it's a good neighborhood. It's an area where people want to live. So my rule of thumb has always been too, if you have people that want to buy homes in these neighborhoods for themselves, then there's a very, very good chance that there's going to be a lot of people that want to rent those properties as well. And these are the neighborhoods where owner occupants will be willing to pay at least market value, if not more than market value. And the factor being the desirability of the neighborhood that drives up the pricing. Those are the areas I really like to target, right? Because retail buyers don't care what the property rents for. They don't care what the cap rate is. They just want to buy that property so they can move in with their family. And that sets our investors up for a solid exit strategy too. Because if you need to sell this house, let's say you do go through a tough situation and the property's vacant for a long time, or you have a really bad turnover and you're upset and you just decide, you know what? You make an emotional decision and you want to sell it. This isn't working out for me. But wouldn't you want a property in a neighborhood where you could easily hire a broker? You could easily for sale by owner this property and sell it to somebody that's not going to care what it's going to rent for, that just wants to move into the house. They'll fix it up. They'll be more than happy to buy a property in a neighborhood that they want to live in and get it at a discount because, a slight discount and put some work into it, because this is a home that they plan on living in for years to come, put their kids in that school district. If your only exit strategy is just to sell to another investor, that's a bad investment in my opinion. It doesn't give you multiple exit strategies. It gives you one. And if that one fails, then you're stuck holding the property. Or if that exit strategy results in the buyer only wanting a discount to take it off your hands, well, then you're losing money. And that, in my opinion, is not a good investment. Owner occupants don't want to buy in C and D class neighborhoods. Only investors typically buy there. And this causes prices to stay stagnant because investors buy on rate of return. They're traded on cap rate, these homes. And they're not willing to pay over market value for properties. How many investors do you know, or you yourself, go and say to a turnkey company, I'll pay over market value for that home to win that bid? No. Investors always want to buy at least at market value, if not below. That just doesn't work. But in a retail neighborhood where owner occupants want to live, they're willing to pay. My mother just bought a brand new home in a suburb of Detroit. She was having the most difficult time trying to find homes. She just finally got one. She had to offer $20,000 over asking to win the bid. I wish that investors were willing to do that, but they're not, because it's all based on numbers and rate of return. And no investor is going to pay over $20,000 for a home that's an investment property. That wouldn't be a good investment, would it? You have to really take that into consideration. Desirability is a very, very huge factor in appreciation, and appreciation is one of the number one way I believe that real estate makes you wealthy. Buying properties in markets on a high growth upswing, getting in at the right time and riding that appreciation wave, and then potentially looking at a refinance, cash out refi, or selling the property down the line. It does not mean it needs to be a long-term hold scenario. Making that equity tangible and putting that equity in your pocket bank account, taking advantage of the 1031 exchange that we discussed last week, and keep deferring those taxes out. I really tell investors all the time too, cash flow is great, but really it's just pocket change. $100, $200, $300. Hey, $400 a month. Is that really going to make or break you? $400 a month is usually going to mean you're buying a D-class property, which, like I said, the likelihood that you're going to keep generating that $400 every month is very, very low. Okay, so please keep that in mind. So really quick, let's take a break. When we come back, I have a couple more reasons why I stopped buying C-class investments. So stay tuned. We'll be right back on the Real Estate Cowboys.
Looking to complete a 1031 tax-deferred exchange and are needing financing for your replacement properties? Let Graham Parham at Highlands Residential Mortgage guide you through the process and make your 1031 exchange go smoothly and on time. As a seasoned investor, Graham owns several investment properties himself, and he can share with you the best way to plan your exchange. Graduate into a better property or properties and make use of leverage to obtain better cash flow and higher returns on investment. Highlands Residential Mortgage has one of the best in-house loan processes to deliver your loan on time and without any surprises. We are 1031 exchange friendly. Call Graham's toll-free direct number today at 855-326-6802 for your free mortgage consultation, or visit us online at texasinvestorloans.com. Highlands is an equal opportunity lender, NMLS 195724, located 1201 North Central Expressway, Dallas, Texas 75234. Highlands Residential Mortgage, NMLS 134871, is not a financial advisor.
And welcome back to the Real Estate Cowboys. We are talking about why I stopped buying C-class investments. And this, like I said, is a topic that I'm very, very serious about and very passionate about. And I have conversations with investors every day about this, and like I said, it's this show, it's not to bash C-class homes. It's not to say don't buy them. I'm just saying this is why I stopped buying them, because a passive experience was important to me. And C-class and D-class properties are anything but passive. Okay. And so another thing that I experienced with C-class homes was high vacancies. And as I said earlier, C-class properties are going to come with the highest vacancy risk. This is due to the low income tenants that they attract and the low desirability of the areas. And if you're also buying these properties in a market without a lot of population growth, that's another, high vacancy sign. You're going to be assuming high vacancy, extended vacancy. Now, for example, if you bought a C-class home in Dallas, you'd probably have still a lot of turnover, but you wouldn't really necessarily have extended, long extended vacancies, because almost 150,000 people have been moving into this market year over year. A portion of that 150,000 people that move into the market are looking for a C-class property. They can only afford a rent under $100, under $1,000 a month. So you still have new blood moving into the market that's looking for C-class rentals. Now, you buy a C-class home in a market like Detroit, for example, or a market like Indianapolis, where there is not a high amount of population growth. You're already running the risk of high vacancies due to a lot of turnover and eviction, so on and so forth. But then you're also increasing the likelihood of an extended vacancy, especially in winter months when the market is very stale and stagnant. Low-income tenants are a greater risk to lose their jobs or miss rental payments. That's a fact. This will result in evictions, as I've said. Some markets in America are very tenant-friendly, like we discussed. Michigan wasn't the most landlord-friendly state that I experienced. California was not the most landlord-friendly state that I've heard from California investors who have done 1031 exchanges and have invested in Dallas, or investors just from California that want to put their money into rental properties. And Texas makes sense because the market's more affordable, but there's still a ton of jobs here. This type of stuff, evictions and having an eviction in a state that's not very landlord-friendly, will result in a lot of heartache, expenses, and loss of revenue for the investor. Like we said, distressed neighborhoods are also less desirable, and this is going to hurt your chances to find new tenants quickly when the property does go vacant. So a lot of vacancy, and the opportunity for high vacancy is common in C-class neighborhoods and in markets with not a lot of high population growth and job growth that are driving people into the market. The last one is the high maintenance costs, which we talked about. The lower income tenants are more likely to beat up on your home when they're living in it. I've just seen it. My investors have seen it. We still do manage some properties that I would call C realm back when we were selling C-class homes. And those are the ones where all the problems come from. Just to be quite honest, I don't see evictions. If I do, it's very rare on my A-class properties. It can become a little bit more common when you dip into the B realm. But when you really get into that C realm, you are talking about tenants that make far below the median value or median income in the market where you're investing. Like I said, if they don't have the best jobs or the best credit score, or they've proven that they can't take care of their own finances, what makes you think that they're going to take care of your home? And so that is something that you really, really need to pay attention to. With A-class properties and higher end properties, now you're dealing with tenants that are higher earners, that have better credit scores, that take better care of things, and which usually results in better care of your property. And it's just, in my experience, I've had to pay more money on maintenance and turnovers of C-class properties than any other property class. And these repairs can be so high that it could swallow up an entire year's return or more. Like I said, the extra $2,400 on a spreadsheet where it makes you look like you're making an extra $2,400, the chances you are going to have to put that $2,400 or more back into the property are so high, higher than you think. And so those are the 5 reasons why I really stopped buying C-class investments and just have really geared my attention towards A and high B properties. And that's why I like to present only those opportunities to my investors. Because really, at the end of the day, I just want my investors to have a successful experience, because I hate taking the phone calls from my investors who are unhappy. It's nothing more disappointing to me than when a property is not performing for someone. And so all I'm trying to do is just decrease the likelihood that I get those troublesome calls. I'm trying to decrease the likelihood that, my property managers are going to be running around ragged because this home is just having issue after issue after issue after issue. We just don't want that type of inventory to manage. And we don't want to put our investors in that type of position, especially my investors that are looking for a truly passive experience. So here's another good rule of thumb. If a property, here's what we do at our management company. In order for the tenant to qualify, one of the ways that they qualify, they have to make at least 3 times the monthly rent gross. So for a property that's C class that rents for $800, that means the tenant only has to make at least $2,400 per month. Okay. And at $2,400 per month, that means that tenant only makes $28,800 a year. If that was in the Dallas market where the median household income is almost $70,000 or might be at $70,000, you're talking about somebody that makes well below the median income. And so the average income for the U.S. currently is about $55,000 per year, $56,000, somewhere around there, which means that these tenants earn over $20,000 less than the nation's average. That should just spell out, that's common sense, that these tenants are just not going to be as responsible, or these tenants they're working positions where it's an hourly wage and the chance that they get fired or quit or lose their job for whatever reason, down economic times, so on and so forth. They're without a job, and it's going to be hard for them to find another job, and they're living paycheck to paycheck, and job loss and things like that are very, very, they're the number one reason why C-class tenants, go through the eviction process. They're on a very fixed income, very low income. Car breaks down, job loss usually can result in an eviction. On the flip side, rents for A-class properties are, $1,800 on average, which means this tenant would make $5,400 per month, which means they make $65,000 per year, pretty much, which is right in line with the middle class median income in the Dallas market, at least, and is actually above the U.S. average of about $56,000. You're targeting tenants that are above the average, above the nation's average. Well, that should make you feel pretty comfortable that you're getting better tenants in the home that will pay their bills consistently, right? That care about repairing their credit or care about saving up to buy their own home. And so they don't want to do anything to damage that, like mess up your home and have you come back through collections to try and recoup that money if they don't pay it, or go through an eviction and have that on their credit. So that's what I found personally. And so another thing about A and C class properties, a difference between an A and a C, I'm just trying to go from one broad spectrum to another. C class homes are generally going to be older properties. They're going to be 1960s builds and below. They're going to be distressed, lower income neighborhoods, as we've talked about. The neighborhoods are going to be heavily occupied by renters. They're going to be smaller homes, and they're going to be renovated with lower end renovations. That's pretty typical for a C class property. Now with A class, you're going to have newer homes, usually built within the last 20 to 30 years. You're going to be in middle to upper middle class, highly desirable neighborhoods. You're going to be in neighborhoods that are occupied primarily by owner occupants. They're going to be a little bit larger properties, and they're going to have middle of the road to high end renovations when you're dealing with that high B to A class property. More durable renovations, better tenants, better neighborhoods, better exit strategy, or more diverse exit strategy, not just one. That's what you're going to get with A-class buildings. And so, like I said, I have properties where I make $50 to $100 a month net cash flow, but I have great tenants where I have no turnover, no issues. The property's been leased out long-term, been very passive, and they've been paying my principal balance down for me monthly. When I'm looking towards the future for when that property is completely paid off and my options available to me at that time where I can just collect my highest amount of cash flow because I've now eliminated my principal and interest payment. Now let's think about my return. Okay, I put $50,000 down to buy a $250,000 home. And then with my initial $50,000 investment, now I'm cash flowing at over $1,000 a month. Wow, great return, 30% in some cases. And then if I want to sell the property for $300,000 or just $250,000 for the same price that I bought it for, well, that's now a $200,000 profit. That's pretty awesome. And that's what these A-class buildings can do for me, these A-class investments. And so I hope that you found this information useful. Like I said, this is all just coming from one investor to another. I'm just explaining what I found worked for me. And I'm just trying to educate my investors on how to really get that passive experience, because If you listen to other podcasts, you listen to other quote-unquote gurus across the nation, they'll all tell you that rental properties are passive. This is passive income. The word passive is thrown around like the word hello in this industry. The fact of the matter is that the further below the median value you purchase these investments, the more risk, the more problems you're going to have, and the less passive experience you're going to have. So if you like what you heard about this, or if you like what you heard on this podcast about why I stopped buying C-class investments, please go to our website, realestatecowboysdfw.com. If you're interested in learning more on how to get involved with higher B-class, A-class properties, if you're interested in learning more on how real estate can pay you in all the 6 ways that are available, if you're interested in learning more about leveraging or maximizing your IRA or 401k to where you can get high fixed rate of return on your money through a private lending option, through self-direction, or if you're interested in learning more about vacation rental opportunities because you're thinking to yourself, hey, I'm about to retire, or I am retired, I want to put my money to work in something that I can use as well and live out my years in paradise when I want to, and when I'm not, I collect some money. We can give you all these options and explain more about how you can get involved in these options. Just go to realestatecowboysdfw.com, put in your information, get on our list, or download our free passive income starter kit to learn more about all these opportunities as well. And for those of you who just don't know which route you want to go just yet, maybe you're new to investing, take our investor quiz at realestatecowboysdfw.com and find out what type of passive investor you are. So a lot of cool stuff to do on the website. Thank you all for tuning in this week. We'll be back next week with another great conversation, more content, and more education on the Real Estate Cowboys radio show. Have a good week.
All opinions expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.